everyone. Yeah, so we're back to our tutorial. Our last tutorial, we spoke about the complete engagement entry. So, just for a recap, to make this video shorter, we spoke about the complete engagement entry that takes opposing liquidity, fueling liquidity, then expansion. Like, for example, this is the opposing liquidity, taken, fueling liquidity, taken, expansion. So there are the three that we're working with. Our text now, let's have what we're working with out there. Opposing liquidity. We'll try to be fast with this video. Fueling liquidity and expansion. So this is the three part of the complete engagement entry. Now, the whole purpose of this video is the top-down analysis. Top-down analysis explains that the market is fractal, meaning whatever is going on in the 1 day time frame is the same thing that is going on in the 4 hour time frame, 1 hour time frame, 15, 5, and as low as you can go or as high as you can go. Meaning our complete engagement entry works in all time frames. The 1 day time frame, the weekly time frame, the 1 minute time frame, it is there. So that's the top down analysis. We can predict the daily time frame from the 1 minute time frame. So we'll be going through the theory of it and we'll check the chart for some live confirmation. Now, what is the whole point of our engagement entry? Engagement entry basically is to get the market in a place where enter the market in a place where it is going to move in your direction. For example, you expect the market to go upwards in a bullish trend. You enter at the bottom of the bullish trend and ride the trend till the end. Like in this case here is it. Yeah. Like in this case here, there was an inducement entry here, a complete inducement entry here. Look at it. You see, we got our opposing liquidity. We got our opposing liquidity. See, no, I'll fix this later. Okay, look at it. We got our opposing liquidity. It was taken, then the price came to take the falling liquidity without taking out the start, then closes. And after this move, look at what happened. Price skyrocketed upwards to this point. See, from here, imagine entering here and closing your trade somewhere here, skyrocketed upwards. So the whole point of the entry now is enter at the low and selling at the high, entering at the high, selling at the low. Meaning, whenever we sell our engagement entry, we expect price to move in the direction for quite a while. Meaning, we have an engagement, a bullish engagement entry, we expect price to be bullish for a while. We have a bearish engagement entry, we expect price to be bearish for a while. So, when we have a bullish engagement entry on the 5 minutes, we expect the 5 minutes to be bullish for a while. And when we have a bearish engagement on the 1 day, we expect the 1 day to be bearish for a while. So this is the whole point of top-down analysis. Let's get into it. For example, this is the 1 day trend, uptrend. Mind you, not all complete engagement entry works as you have to align them with the up one day uptrend. Now you now have an internal trend, which is like, let's say, your 15 minutes coming down. You see, in this case, let's take the theoretical uptrend. In this case, in a place like this, you and I will not be looking for a bullish engagement entry because this high has been taken. After every high has been taken, probably we call it break of structure. I'm not sure I've explained it. So let me quickly explain this. Price goes up, comes down, immediately takes this high. We call it break of structure, goes up, come down, break of structure, goes up, come down, break of structure, goes up, come down, break of structure. So immediately after every break of structure, we expect a pullback as it happens. Break of structure, pullback, break of structure, pullback, break of structure, pullback. So if we're looking for this, assuming this part, this huge part is a 1 day time frame, and this is a movement in our 15 minutes time frame. If we're looking for a 15 minutes entry in a place like this, we have to pay attention to the 1 day in the sense that in the sense that the 1 day has broken structure here, and after every break of structure, there's a pullback. So the pullback now will be a bearish pullback. It will not be wise to be looking for a bullish engagement entry in a place like this. You see, it will be safer to look for a bullish engagement entry in a place like this. When you get it, you see engagement entry, you trade it up and take your profit here. While in a place like this, you look for a bearish engagement entry. So, peradventure, the market does what the market does. Peradventure, you get a bullish, a sign for you to buy and long your trade here. Given that you have done your multi-time frame analysis, your top-down analysis, you see that this is going on the uptrend. You avoid this your bullish engagement entry and wait for a bearish one, trade the reversal. At this bottom, you wait for a bullish one, then continue the trend. That's just basically what top-down analysis is about. It's telling you like, okay, this is what's going on, but this is like the theoretical part of it in our uptrend, downtrend sense. So we're going to explain it in the sense of our complete engagement entry. Here's how it works in our complete engagement entry. Let's say this is, let us give ourselves a daily time frame. Yeah, let us give ourselves a daily time frame downtrend. Now, opposing liquidity has been taken. Foreign liquidity has been taken. Okay, let's bring this one down. Now, foreign liquidity has been taken. Don't worry, I understand very soon. Then we have this. Now, this is the daily time frame complete engagement entry. Now, in this daily time frame, after fueling liquidity has been taken here, what do you think should be the next move? An expansion to the upside, right? And when you have a complete engagement entry, you are good to go. But how will you know when this move has started? You go down to your lower time frame. In this lower time frame here, we look for a complete engagement entry here. So our lower time frame will have something like this. In our lower time frame, we'll have something like this. It's not looking good at all. That's it. It wasn't looking good at all. Something like this. You see. Now, this is assuming this is a 15 minutes time frame. Now, opposing liquidity token. You see. Now, lower time frame, we see something like this. Sorry for how rough it is. So, when we see this complete inducement entry here, we see this complete inducement entry here, we long it. You see. So basically, what we're trying to say is all time frames work together. Instead of waiting for you to for price to move to this extent before you long it, then you put your take profit here. Look at it. You could long at this point, put your take profit, put your stop loss at the low. You see, for someone that is waiting for price to get to this point before he enters the trade, look at it, you have already made 2.7 risk to reward before that person even enters. You see, then the higher time frame, the 1 day time frame might be targeting this high because when price gets to this high, when price gets to this high, according to your 15 minutes, it will come to this high. When price gets to this high in your 1 day, it has formed a complete 1 day. Then price is expected to come here. You are getting a 1 to 5.6, 1 to 5.6 as against entering at your 1 day, putting your stop loss here and getting, you see, a 1 to 1.2 to 5.6. You see the difference. And this is not the end of it. You see, as the 1 day is an higher time frame to the 15 minutes, so is the 1 minute a lower time frame to this 15 minutes. So somewhere along here, somewhere along this place exactly, you can get a 15 minutes complete inducement entry, your stop loss here. It's instead of waiting for price to get here before you enter, the 15 minutes tells you it's coming. Then price get to this place, you have a complete 15 minutes inducement entry. By then you already have like okay 0.92, a 1 to 1. Then price gets to this place. By then you already have a 1 to 8.71, and that's where the 1 day people they're entering somewhere here. Okay, let me break it down a little bit. Let's see. Somewhere here. You already have a 1 to 6. Then price gets to this place. Then you have a 1 to 17. It is possible. It is very much possible as long as you pay close attention to your multi time frame. Like now, this one right here, this one in the middle, is what you get if you enter based on the 15 minutes time frame and the this one you get it when you enter based on the 1 day only, a 1 to 1. You get this if you enter based on the 15 minutes and the 1 day together, a 1 to 5.67. Then this you get it when you enter based off the 1 day, 15 minutes, 1 minute, 1 to 17. Meaning, let's say if you are risking $100 on this specific trade, at the end of the day, you'll be making $1,725 of this trade. For me, that's better than a 1 to 1. So just be patient and do your multi time frame analysis. I believe we all understand it. So there are certain things I want to point out to you. There are certain things I want to point out to you. Now, For your inducement entry, there are two places where we can enter it. You enter for a short trade and you enter for a long trade. Like this, when the opposing liquidity has been taken, you enter for a short trade. You see this trade here, this trade here, it could go down all the way to the bottom like this. Go all the way to the bottom like this. Takes the opposing liquidity, then keeps going. You see, but then you could look for a complete inducement entry here on the lower time frame, enter and follow the trend, or you look for a short profit, or you could align yourself at the falling liquidity of the higher time frame. You see, you enter at the opposing liquidity of the higher time frame, short profit, enter at the falling liquidity of the higher time frame, long profit. Then there's something I love doing. There's something I love doing because price market doesn't just run like this, does it? It moves in steps, then it comes, sorry, it comes, it goes, then it comes again. You see, so there's something I do. I call it riding the trend, milking the trend, whatever you want to call it. So in a case like this, let's say this is the 1 day time frame. I enter at the lower time frame somewhere here, 15 minutes after full liquidity has been taken. This is my beginning. I ride the trend. By the time I see liquidity has been formed there again, I call it another falling liquidity. Once it's taken, as long as my higher time frame goal has not been achieved, let's say I have a liquidity here that I know price is moving to it. As far as it hasn't gotten to this liquidity, and I see a falling liquidity taken, I take it, I enter probably at the 15 minutes time frame again. Then I get a falling liquidity here again. I enter the 15 minutes time frame. I get a falling liquidity. I enter the, you see, that's what I do. So at the end of this whole trade, I have a position here, a position here, a position here. I just run the trade along. Then my trade end up being something like this. Take profit here. Take profit here. So I believe you understand. So at the end of the day, I end up having a trade like this: first position, second position, third position, fourth position. Why? Because I already know that this is a 1 day trade, and there's no a 1 day trend, and there's no threat until price gets to this liquidity. You know everything is a game of liquidity. So that's it. That's basically it. That's how it works. That's how it works. Multi-time frame analysis. You start your analysis from the higher time frame down to the lower time frame. Then you check for threats and the rest. Avoid threats. Like for example, and know that after every opposing liquidity is taken, there's always a pullback. Just the way after breakup structure, I've explained breakup structure. For example, now this is the 1 day time frame. Now we have opposing liquidities. After this opposing liquidity is taken, after it is taken, I expect after it is taken, this opposing liquidity is taken, I expect a pullback to look for falling liquidity. I do not expect price to do something like this. No. What I expect is for price to come and take a fall in liquidity. After each opposing liquidity is taken, expect price to come and take a fall in liquidity. Always, always. So if price does something like this, for me, I don't feel safe entering or looking for trades here. Because some people, after it has taken and there's a pullback, let's say complete engagement at a lower time frame here, they trade it. That's not what I do. I make sure if falling liquidity is taken at the higher time frame. It is important. I told you the last video I told you there was a part I wasn't letting you know, and this is it. The fueling liquidity, the liquidity of the higher time frame. It is as much as important as your complete engagement entry. It is as much as important as that. So tick for the liquidity of higher time frame, then boom. I always look for this. I always look for this. Then let's say right here, there's another higher time frame opposing liquidity. Price might choose to respect this one, comes down. You see, I always look for this. Some people will just as at this point, once price react of it, some people, once price react off it, at this point they start looking for complete engagement entry. No, that's not how it is. I always wait for falling liquidity to be taken. Always. Then you ride the trend. You're safer that way. You're safer that way. So let us go to our chart and show you some life example as it should be. This is $0. Here is the 1 day chart. Here's our Bible, opposing liquidity, fueling liquidity, expansion. So here's our 1 day chart. What's happened here? What happened here? What happened here? Okay, I'm coming, I'm trying to get the hang of it. Alright, let's see this at the 1 day chart. There we had a downtrend here. Then took at this point, you see, it took falling liquidity, then came down. We had a downtrend here. We had a downtrend here. Now, price has chosen to reverse upward, and this is the closest falling liquidity. Sorry, the closest opposing liquidity. Hmm? All right, let me remove these ones so that everywhere will be clear. Let me remove these so that everywhere will be clear and work with just the lines we have. Okay, now you see this is the closest opposing liquidity, and we told you phase one lasts for as long as opposing liquidity has been taken. Yes, then after it has been taken, you look for foreign liquidity to be taken. Now, price moved all the way down, all the way up rather. It crossed it here. There was a rejection. For some people, they start looking for complete engagement entry here, maintain it has been rejected by this opposing liquidity, then boom. No, you look for complete engagement entry after the falling liquidity has been taken. Now, it went up again, created another high here. There's liquidity here, liquidity here, liquidity here. Then price came down, came all the way down before it started moving. It came all the way down to take this liquidity, but it did not take the start. Now, while price is coming down after this liquidity has been taken, after this 1 day has been taken, that's where we'll start looking for complete engagement entry on the lower time frame to the upside. So let us go down to the 4 hours time frame. You see, this is it. After it has been taken, you start looking for complete inducement entry. Now took it the complete inducement entry here. You see, now opposing liquidity here was taken by this I, came down, but there was no close. It broke it here slightly, but I believe you can see it. It broke it here. You see, so this is our low. This is our low. This low here. Now let us go down to the 1 hour time frame since 4 hours isn't giving us to go down to our 1 hour time frame. Mind you, you don't have to wait for all this to happen. This could be things that have already happened before. You study the happenings on the charts, things you are meeting. Now look at our 1 hour time frame. Isn't this marvelous? Is it not? Look at what happened here. There's opposing liquidity here. Okay, let's draw this big. Let's draw this big. Yeah. There's opposing liquidity here. Though there are opposing liquidities here. Oh, okay. Okay. Let us do this. There's opposing liquidity here. Let's work with this one as it was the last one. Yes, opposing liquidity here. Now, look at our move. Opposing liquidity was taken. The falling liquidity, if you look properly, there's liquidity here, there's liquidity here, there's liquidity here. Falling liquidity was taken. So let us mark this our first falling liquidity on the 1 hour time frame. Then we go down to 5 minutes time frame to look for entry as the 1 hour falling liquidity has been taken. Mind you, remember that this line here was the 1 day falling liquidity being taken. Now the 1 hour falling liquidity has been taken. Now look for 5 minutes entry, though you can go down as low as 1 minute. Yeah, I do that sometimes. Sometimes I have my rules. At the end of this, I will give some of my rules away. So my specific requirement for entries. Look at the 5 minutes now. After the 1 hour liquidity has been taken here, let us take a look at our 5 minutes time frame. Check this out. Let us draw a line here. You see, this low was not taken. It wasn't. And look here, there's a liquidity here. Price came down, went back up. You see, this candle engulfed this. This candle engulfed this. So there's a liquidity here. Let me mark it at the top of this. If you go down to the 1 minute time frame, you see it clearly. There's a liquidity here. So liquidity was taken. Then there's the opposing liquidity, as you may have it. Then there's a falling liquidity here. Falling liquidity was taken, but the low wasn't taken. Then there's a candle close here. There's a candle close here. You see. So let's delete this. Point has been made with this. Delete this. Point has been made. So across this line, the first candle close happens to be this one. That's where we long our trade from. We long our trade from this. Stop loss below. Then we take our take profit. Given that our analysis started from the 1 day, our analysis started from the 1 day. That's where we aim our take profit at, so as not to leave profit on the table. Oh, made a mistake. I was supposed to widen this. Yeah, so now we can see it. Remember, our analysis started from the 1 day time frame. Let's delete this. Started from the 1 day time frame. This being opposing liquidity taken, and after opposing liquidity has been taken, falling liquidity has been taken. If price closes above this 1 day time frame, if price closes above it, where do you think price is going to? It will get here. Chances that it will get here. But let's work with this one. Let's work with this one to get here. So for a very, very, very patient trader, now this is not for day traders at all, because you and I know that this trade will take a lot for it to close. So you take this, take your take profit here, or even if you want to take it here, you see, because this is where price is currently. Price hasn't come beyond, but I believe it's coming here. Take your take profit here. Or let's say we don't want to, let's work with what we already have. We put it at this where you have your complete investment entry on the 1 day time frame. Check it, 1 to 17, as we had it in our theoretical exploration. Quite ironical, right? If it's here, as you may have it, 1 to 22. People say go for 1 to 2, 1 to 3. Yes, what I say, I don't say always aim for this long. Well, when you have a 1 to 1, you take a 1 to 1. When you have a 1 to 5, you take a 1 to 5. You have a 1 to 22, as this case may have it. You take a 1 to 22, come on. Why leave profit on the table? Hmm? The profit is there for you to make it. And like I was saying, I will always have liquidity taken, falling liquidity. So look at it. Let me just use one stone to kill so many birds. After entering here, price rallies up. There's an opposing liquidity here, a strong one. Let me draw it. You see, price hits the opposing liquidity, comes down. If you see, there's liquidity here, there's liquidity here, falling liquidity. Price hits this opposing liquidity, comes down to take the falling liquidity. So let us go to the lower time frame and see if there will be an opportunity to enter a second position in this. Look at it. I know I haven't told you how to look for the lowest, the lows in scenarios like this, but here's it. So this was the first liquidity taken, first falling liquidity, and this was the second falling liquidity taken. So let's go to the 5 minutes time frame if we will see entry on it after the first falling liquidity was taken. You see, the first falling liquidity taken in this case, then almost an inducement entry, almost, but there was no candle close above this. Price plummeted downwards. Now look at what happened again. There was no opposing liquidity taken here, plummeted more. Now look at this beautiful work of art. Here, opposing liquidity was taken here, but it did not give a complete inducement permitted. So what are we looking for? We're looking for something that will give us a complete inducement entry. Mind you, this is now an opposing liquidity and it has been taken here. You see, taken, falling liquidity, taken, close here. So we have our complete inducement entry on the 5 minutes time frame being somewhere here, because there's an opposing liquidity that was taken when price crossed here, falling liquidity here that was taken when price crossed with this. Now a candle close here. Now we have a second position with our stop loss coming here. This might actually be bigger than the first, as I can see. You see the difference. The difference is much. You don't always have your cake after you've eaten it. So we have this. Then we go up to our 1 day time frame as is our tradition to look for our take profit. What have I done? This is too thin. Let me go down to the 5 minute back. Let's go down back to the 5 minutes and get what we're looking for. Let's go down. How here did we keep this thing? Okay, it's here. How is this? It's here. So let's make it wide enough. Okay, that's wide enough. Okay. Yes, we have it now. You see, this is another profit to be made. Now you have two positions running. One is 1 to 22. This one is 1 to 5.9. Very good. Very good. Now there is, let's go to the 4 hours time frame. You see, there's liquidity here. Sorry. Yeah, opposing liquidity here. And you know what opposing liquidity does? Opposing liquidity causes the foreign liquidity to be, for price to go to foreign liquidity. Mind you, there's the reason I picked this, which is quite tricky. This is the 4 hours opposing liquidity. Now, this liquidity taken here, this liquidity taken here is the 4 hours falling liquidity. This liquidity taken is the 4 hours opposing. This is the 4 hours falling. Now let us look for entry here. Oh, sorry. Let's go to the 4 hours. Let us look for entry after this. I feel these lines are too much. Let's delete the unnecessary ones. This delete. This delete. Let's look for entry after this foreign liquidity has been taken. After this foreign at the 5 minutes. Sorry, 5 minutes. Okay. There you have it. This is the falling liquidity that was taken. Now, at your 5 minutes, you have your complete investment entry as you have it. Yes, your opposing liquidity taken. Yes, falling liquidity taken by this move. Your close here. Now, I want to show you something really tricky. Something really tricky why you actually need your top-down analysis. This quick profit. Why you need your top-down analysis. In this kind of scenario, one will actually want to target this high as it is the 1 day high. Let's go to the 1 day. But here's the tricky part. Here is the very tricky part. Okay, let me go down to the 4 hours. Here's the tricky part. The 4 hour falling liquidity has been taken. You want to take it and target this 1 day high as you have with these ones, right? Look at it. 4 hours falling liquidity taken, but the 1 day falling liquidity has not taken. The upward move made a 1 day high to be taken, a 1 day opposing liquidity. So expect these things. It's how you think that matters. There's an opposing liquidity here. Expect that there'll be a reaction of it. Like look at the last opposing liquidity on the 1 day. Look at it. The last opposing liquidity on the 1 day was taken here that caused a huge movement. So there's something here. Expect that it will cause a movement as well, and the 1 day opposing liquidity will be taken, meaning the only opposing liquidity here, sorry, falling liquidity here is this one here. So you expect it to be taken. So this your move here is quite too much, quite on the high side because opposing. I know you get it. Opposing liquidity taken, falling liquidity taken. So this move like this, we look on the whole picture and see that there's an opposing liquidity here that will most likely take out this stop loss. We take it here, a 1 to 3.77. You see, we look at the whole picture. Don't just focus on one time frame. This is the whole point of multi time frame analysis. Do not just focus on one time frame. Then after you've made this one, there's liquidity here, 1 day liquidity that should be taken. Then you have your entry. This is where the market is currently. Sorry, network is delaying. This is where your market is currently. I don't know why the network delaying all of a sudden. I don't know why. Network is bad. Okay, yeah, we have it now. We have it now. 5 minutes. So this is the liquidity. The 1 day liquidity, the 1 day falling liquidity that was taken. Look at it. So at this point, what we're looking for now is the 5 minutes complete inducement entry. As you can see, I am waiting for it. I'm waiting for it because look at it. Opposing liquidity taken. Opposing liquidity has been taken. Then look at there's a liquidity here. Falling liquidity taken. If price closes above this high, yeah, I'm entering one. Let's see. Take it and we're targeting it on our 1 day as we should always do. And this is not the end. This is not the end. This is not the end. We're targeting not this high, as you know, but our 1 day high as we have. So 1 to 6.7. And mind you, this is a 5 minutes, so we're going to see a lot popping up, and a lot of entries. So at the end of the day, you actually have quite a lot going for you here. You have quite a lot going for you. First entry, second. Mind you, this is not just it. You will have more. Like in this one now, it's not just it during the day or during the move. We'll milk the move. Make sure we enter multiple places as possible, and do not enter at risky places like when price crosses this eye somewhere here. There's an eye here, crosses this eye somewhere. We'll pull back. So we'll avoid entering somewhere here. Let me give it to you. There's a high here. Let me delete this. There's a high here. Price will probably come all the way and cross it. There'll be a pullback before it comes here. So we'll avoid entering within this zone. Within this zone, you see, we'll avoid entering within this zone. But after it crosses it, takes forwarding again, then we can enter at this bottom, another entry. So that's all for multi-time frame analysis, top-down analysis, whatever it is called these days. So that's it. I said I'll give a cheat code. give you a cheat code for at the end of the lecture, right? I will give you what I normally use. Coming. I have four phases I use normally for my trading: phase A, phase B, phase C, and phase D. Phase A, phase B, phase D, and phase C. This one actually I got inspiration from Photon Trading on YouTube. So shout out to him. Now we have a huge trend. We have a huge trend, and we have internals. Sorry, let me not do that. We have a huge trend, and we have an internal trend. We have our huge trend, we have our internal trade. So my phase A, phase B, and phase D. Phase A is pro swing, pro internal. Mind you, these are not mine. Like I said, shout out to Photon Trading on YouTube. If you want to understand this better, but it will not explain it from the whole from the whole perspective of complete inducement entry. Now phase A being pro swing, pro internal. Then phase B is pro swing, counter internal. Sorry. Counter internal. Sorry, just give me time to get this done. Why this is counter swing. Why this is counter swing. Sorry, this is counter internal. This one. So this is how it is. Meaning, let's say the swing is the higher time frame trend, the internal is the lower time frame trend. So these higher movements here, they are swings, uptrend swings. Then within this down movement, there will be within the down movement there will be internals. In fact, within all the movement, there are internals. So the internal is something like this, the lower time frame. You see. So this is it. This is your internal. Yeah. This is your internal, this is your swing. Yes. Pro swing means in the direction of the swing, the whole thing, the direction of the higher time frame. Sorry, yeah, of the higher time frame, the huge swing. Why internal is the direction of the lower time frame. You see, because yes, this move here will be a lower time frame uptrend. This move here will be a lower time frame downtrend, a lower time frame uptrend, lower time frame downtrend. So pro swing pro internal is when price is moving in direction of the higher time frame and direction of the lower time frame. Pro swing, pro swing B, pro swing counter internal is price is like okay, I'm coming. Let me explain this better. Yeah, I need pink. So we have something like this here. Sorry for the messy diagram. Yeah. So pro swing, pro internal price. The higher time frame and the lower time frame are moving in the same direction. So this is this move here. This move here. The higher time frame is moving up. The lower time frame is moving up. So this move here is the pro swing pro internal. The pro swing counter internal, meaning higher time frame is moving while the lower time frame is moving in the counter direction of the lower time frame. Now look at it. Lower time frame is moving up. This is the swing. Then lower time frame is moving down. But as at this point, we are going against this lower time frame downtrend, against it. At this point here, we are going against it. So this is at this bottom, this is your B, pro swing counter internal. That is after catching the low of after the falling liquidity has been taken. I just hope you understand this because I know I'm not doing justice to it as it is in my head. This is your B. Then, and there's a reason I called out a photon. You understand it better if you go through them. Now, this is your A. Now, C is counter swing pro internal, meaning you are trading against the higher time frame but in the direction of the lower time frame. So that would be somewhere here. I'll explain that one as well. Then D. D is counter swing, counter. And I place counter swing here instead of counter swing. Pardon me. So let me explain it now. A. This is A. Okay. This is A. B. This here is B. This here is C. And this here is D. So pro swing pro internal. This is A, meaning the higher time frame is going up. Lower time frame came down, but now the lower time frame has started going up. So we're trading in the upward direction. So we're trading in the direction of the swing and trading direction of the internal. Now, pro swing counter internal. The higher time frame went up. That's the B. The lower time frame is coming down. But now I want to catch it at the middle since the higher time frame falling liquidity has been taken. I want to catch it. So we are trading against this downtrend of the internal time frame and in direction of the uptrend of the higher time frame. So that's pro swing counter internal. Then C is counter swing pro internal. You see the higher time frame is going up, but C time frame is coming down, meaning it's going against the swing, the higher time frame. But then look at the lower time frame. The lower time frame trend has already started, so C is going in the direction of the lower time frame. So, but it is going against the higher time frame. That's counter swing pro internal. Then D. D is going against everything. Higher time frame is coming up. And remember here there will be lower time frame going up here. So it's going against this one that is going up, and it's going against this one that is going up. So let me draw this one for you to see so you'll not be confused. Yes, there will be one here. So what D is doing, D is going against this as this is the trend that exists before D. So when you are trading here, you are going against both. You are shorting, you are going against your internal time frame, you're going against your swing time frame. So that's basically it. So what I do is whenever I'm trading D, I'm careful because I'm going against both. Anything could happen to me. When I'm trading C, I'm careful because I'm going against the higher time frame trend. So C definitely could not go far. It cannot go far. But when I'm trading B, I'm a little bit more careful. I catch my B and take it long because it's going in the direction of the higher time frame. When I'm trading A, I'm a lot less careful. I take it So here is my own person. This is from Photon. Here is my own personal cheat I use. Okay, here is it. When I am trading phase A, what I look for is I look for a 1 day liquidity that has been taken, higher time frame liquidity, yes. But my entry is basically a 15 minutes and a 1 minute time frame entry. 15 minutes, 1 minute. Then a 1 hour, 1 minute. Meaning I look for the falling liquidity of my 1 day to be taken. Then for my entry, I look for the 15 minutes and 1 minute, meaning the 1 minute should take, meaning after the 15 minutes falling liquidity has been taken, I enter. Meaning, here's it. I treat this higher time frame. Like after my 1 day falling liquidity has been taken, I treat the 15 minutes as my higher time frame. Treat the 15 minutes as my higher time frame. Look for the falling liquidity to be taken. Then look for a 1 minute complete inducement entry and I trade. So this is what I do for phase A if I'm catching it at, sorry, phase A. Nah, 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 I just got this wrong. Okay, let me come down to phase B for you to understand my phase A. I'll explain it to you. Phase B is 5 m. Phase B is always the start of the move. 5 m and 15 m, 1 m. Yeah. Phase B is the start of the move here. When after my higher time frame falling liquidity has been taken. Let's say this is the 1 day higher time frame falling liquidity at 1 day or 4 hour. So I come to B, which is my entry. I look for a 5 minutes inducement entry, a 5 minutes complete inducement entry. Once I get a 5 minutes complete after 1 day has been taken, I enter the trade. Or I look for a 15 minutes and one, meaning a 15 minutes forming, then a one. You understand? 15 minutes acting as, let me explain that. A 15 minutes forming, then from here, a 1 minute forming. I believe you understand it. So this is what I look for at B. At B. So after B starts moving, I told you there will be reactions of it. So the 15 minutes will react and form falling liquidity. After the falling liquidity of the 15 minutes is taken, I look for a 1 minute complete inducement and I go into it. That's the 15 minutes one. And in some cases, it will be a 1 hour falling liquidity. Look for complete inducement, enter position two. Look for 15 minutes falling liquidity again. So I can have A here, I can have A here as well. You see, why B is always the start. I can have A in different places. I can have A here as well. Can have A here. So you see, I enter at B, meaning 5 minutes of 15. Then I keep looking for 15 minutes one because I know the trend has been established. So just right. C. C. I work with 15 minutes one, just like A. Sorry, 15 minutes, 1 minute. Then I work with 1 hour, 1 minute. Then D. I will explain C and D now. D. I work with 15 minutes, 5 minutes, 1 hour, 5 minutes, 4 hours, 5 minutes. This is what I work with in D. Meaning, D is going up against the internal and against the swing. So I need a lot more confirmation. That's why my D is always 5 minutes. To start this move, I always wait for a 5 minutes. Like at this point, I wait for 15 minutes, then a 5 minutes inside the 15 minutes. When I get it, I can trade this. Or I wait for a 1 hour, then 5 minutes inside the 1 hour. Or in some cases, this 4 hours is my highest time frame. I wait for 4 hours, then 5 minutes inside it. And when the trade has started, that's where you get your C. Just like A, I can use 15 minutes one, 1 hour one, because if falling liquidity, 15 minutes falling liquidity will be formed there. The 1 hour, the after the falling liquidity taken, I look for a 1 minute, trade it. A 15 minutes falling liquidity forms again. You see. So this is just basically my model. It's scattered, I know, but this is the best I can do with the time duration. So this is basically my model. And okay, I think I should add everything here. My hour time frame. My hour time frame is the 1 day and the 4 hours. My medium time frame. I work with three different time frames. Sorry, three different levels of time frames. That's my 1 hour and my 15 minutes. Then my lower time frame is my 5 minutes and my one. Many will say it's too confusing. Stick to just three or two. Nah, I rather have the whole picture and know the whole story. So basically, when I say higher time frame, once my higher time frame falling liquidity is taken 1 day or 4 hours, I look for medium time frame entry 1 hour 15 minutes. Once one of them is taken, their phone liquidity is taken, I look for this one. Then when I'm going opposite, you have the whole thing here. I've explained it. Believe you understand it. If you don't, please try to rewatch. Then our entry as we always have it. We know how it goes. Opposing liquidity, welling liquidity, then expansion. So I just feel we should have everything in the screen. Please try to understand for this model. If you do not understand it, I will advise this you go to photon video. I will find a way to put the link. You watch it on YouTube. It will not explain it in terms of whether liquidity or opposing liquidity. It explains it in terms of uptrend, downtrend, market structure. So if you understand what it's explaining and come back to watch this one, I believe you understand everything perfectly. So that's it. That's all for now. If there's more, I think I will create another video, but this is all that is required for now. Thank you.